Hi there everyone, morning and welcome to the market right here on ET Now with me, Avanne Dubash. We've got Nikunj Dalmia and Ayesha Faridi joining in a bit. Well, yesterday, whatever played out for the markets, the sell-off clearly intensifying. 19K was nowhere in sight as we breached some very critical levels on the downside, most of the sectors wrapping up in the red. But that being said, let's also take into context then the kind of macroeconomic data as well that we got from across the globe, because the US GDP grew at the fastest clip in the last 2 years, with the annualized Q3 print coming this time around coming in at 4.9%. In fact, the annualized Q3 print at about 2.7% for CY22, and this time around coming in for Q3 CY23 at a solid 4.9%. So perhaps showing that there is resilience in the global economy despite the economic uncertainties. You can see the US markets as well cheering that news. You've got Asia as well getting off to a decent start. That being said, you had a pretty somber move coming in on the Dow Jones, the S&P 500 declining, and the Nasdaq as well slipping in trade. So clearly, Nikunj, showing that there is resilience when it comes to the US economic growth.
TGIF. That's what matters.
That's the move, yeah.
It is a truncated week, but this week looks so long and prolonged largely because of the market action and the news flow, which in a sense has just surrounded
It's really
us.
been draining.
Yeah.
Starting off from Monday.
And there was a holiday. So it's technically been
Didn't
truncated.
really help.
Didn't really help. So TGIF, guys, TGIF, thank God it's Friday. Now look, US economy. And it amazes me that at the beginning of the year, what was the narrative? The narrative for the US economy was that it would be a soft landing, it could be a mild recession, but a slowdown is coming. But the recovery in the US economy, and if you look at the GDP data and the contours of the data as well, it's way above what everybody was anticipating. Even best of the bulls, I think they couldn't imagine a print of anywhere close to 3.5%. We got a print of 4.9%. US consumer is making a comeback. US economy is resilient. How does that matter? Well, that means that will rates go higher? If rates will go higher, what will happen to rate sensitives? What will happen to interest rate sensor? What will happen to some of the technology and high beta names? What will happen to market valuations? So I think now that real narrative of such a strong GDP print, what happens to Fed? How will Fed take a cue in the next meeting, which is due in November? And will there be a change of narrative? So that would be the chatter, at least this Friday morning, if you're analyzing the global cues, that how everybody in a sense who had predicted a different path for US economy in January 2023 is simply stumped. In cricket terminology, is simply stumped and bowled with what the trajectory of the economy is. So what happens to the dollar index? Well, a measured move. But for rate sensitive, and especially for some of the companies which essentially are richly priced stocks, there a fear of interest rate hike could have an impact in the near term positioning.
Yeah, the only chink in the armor, so to speak, is that better GDP for the US also means rates go up. For now, though, markets are seeing a bit of a rebound after getting into almost an oversold zone. Even if US futures right now, they are trailing in the green, as is the case with Asia as well. In fact, the pre-markets rate are comfortably in the green for US equities. What about our markets? A mammoth FII sell figure, 7,700 crore rupees, no less. We broke the back for the Nifty yesterday, slipped below 19K, breached that 18,900 mark as well. But interesting to note that 7,700 crore rupees was the FII buy figure. The DI sell figure, the DI buy figure was as big.
So, Ayesha, if you just look at the FII sell figure in isolation, it just marks off some compulsive selling.
Yeah.
You don't get such a large sell figure till the time you don't have a compulsive selling. And if you map the FI figure in the cash market with the FNO market, there is no arbitrage at play here. So it was a compulsive selling, which was very neatly absorbed by the market. Because frankly, with 7,000 crore of sell figure, if DIs were not standing on the other side of the table, the market would have actually broken down. Now, you got to analyze and say that is this just one-off, or this is beginning of some kind of a risk-off rally in emerging markets, and could this cause a selling stampede? Very difficult to say that. So you have to take each day as it comes. But what I like about the market yesterday, that some of the rank mid-cap stocks, they've started making a comeback. Now let's look at it. I mean, we got delivery data to establish that where some of the stocks have fallen, and I think selling was very universal. This kind of a sell figure means that some of the heavyweights essentially, broken down. Now that's the number which matters to me. Look at JSW Jindal Saw, 17% up from yesterday's low. Garden Reach, 15%. Apar, 13%. Bombay Stock Exchange, 13%. MCX, 13%. Some of the banks also made a strong comeback. So within the small and the mid cap space, we saw marked recovery, and the market now, stocks which have a story or which have a fundamental substance in the small cap space, they are making a comeback. B, domestic institutional investors are sitting on high levels of cash, so a little bit of selling by foreign institutional investors would be absorbed. So, and third, I guess banks and private banks now really hold the key, given how the market narrative is clearly favoring some of the private banks. So there are three parts to the market. One, large FI selling which was absorbed. B, some of the mid and the small cap stocks from the day's low, they found some takers. And C, the narrative, I think, again, I'm sounding like a broken record here, but you'll have to go back to banks, because for me, that in a sense will be the real canary in a coal mine to tell us which way things are moving.
Right. And just to pick up on the point that you were earlier making about FIIs, the fact that their long positioning is pretty much nearing an all-time low. All-time low was about 9%. For this series, 11%.
Yeah, so it's interesting that typically markets always bottom out when the FI positioning is low, long positions, or the selling cash figure is high. We are nowhere close to the peak FI investments in the Indian market. The storytelling, the narrative for Indian market, nothing new, is domestic investor and retail investor. So if history is anything to go by, markets tend to bottom out more than often when this kind of a selling pattern is at play. So let's hope that history is at play right now, because with this kind of a narrative in terms of where the Indian economy is moving, where the valuations are, I think if not today, tomorrow, I think the fundamental bottom in large cap stocks, I think, is nearing. I would again say the same thing what I've been maintaining, that this is a bull market correction, folks. In a bull market, the correction is going to be very sharp. It's going to be very savage. There were excesses in the market, and some of the excesses are getting flushed out. I think now you have to, so from no action, now you got to just raise your ante and say that, okay, these are the stocks I always wanted to buy in the mid and the small cap space, and where I'm getting the bargains. My sense is there are two pockets. One is large cap banks and second is pharma. These are the two pockets. One is value, second is growth. So pharma is value and a little bit of growth. Banks is growth and visibility. These are two pockets where I think in the near term we will do well. See, if US economy is doing so well, we'll have to look at sectors which will benefit from that. I don't think IT is benefiting, but pharma will benefit, exporters will benefit. US economy is coming back because US consumer is coming back. What will the consumer consume? They are not consuming from China. So the goods have been exported from somewhere else, and India is going to benefit out of that. How simple is that?
And private banks are looking cheap right now. I mean, just looking at the valuation parameters as opposed to the 5-year averages.
Yes, sir. That's what everybody is telling me when I say, private banks are looking cheap. See, there are times in the market where compulsions are at play. And with this kind of a sell figure, I think there is some compulsion which is at play when, these adjustments are happening. So banks do not deserve to underperform, but they are underperforming because everybody was overweight banks, and there is a raft of selling which is happening by foreign institutional investors which own banks. So 3 months from now, 6 months from now, a year from now, I'm reasonably confident that large cap private banks have got all the ingredients in the melting pot which can make them an outperformer, because credit is strong, risk of NPA is not there. They are growing without raising capital, and then valuations are attractive. Typically, when you see this kind of a combination, then the follow-up of this kind of a combination always is that you will see a bout of outperformance. Let the compulsive selling get over. But stay with private banks. I mean, that's what I would think.
Growth visibility is very much evident when it comes to the banking space, that along with pharma, says Nikunj. Let's move right on then, and it's going to be a busy day on the earnings calendar. Earnings heavy as ever, because you've got a lot of weightage on the Nifty that will be coming out with their numbers today, close to 15.4% in total. A bulk of that, of course, coming in from Big Boy, Reliance Industries, and then Maruti, Dr. Reddy's, Cipla, BPCL. I'm sure your eyes are reined in on RIL, Nikunj?
It's an important number, but it's not going to be a market moving number. because expectations are limited. Reliance has underperformed. GRMs have been all over the place. There is nothing big bang in terms of an expectations which you would really hear from Reliance. So, last quarter, everybody was excited to understand the real growth map of where Jio Financial Services is moving. So more than absolute Reliance numbers, I would say that the roadmap for Jio Financial Services really could be important and it could be crucial. Actually, let's revisit our exclusive yesterday. Yeah, we broke that story that Somit broke that story that Jio Financial Services promoters have actually increased their stake, and they've increased their stake in a very meaningful manner, just a shade below 50 now, but they've been increasing their stake in Jio Financial Services closer to 210 to 15. So this is the third or the fourth tranche. I think they've done that. But yeah, Reliance is important. Maruti would be crucial, and that's about it really. I mean, in terms of heavyweight, those are the two numbers which would be important. Expectation from Maruti high, from Reliance, I think they're neutral in terms of where they are. 15% of the Nifty comes out with weightage. As you go along, we'll tell you about the Jio Financial story also. But in terms of earnings, it's Reliance again.
Yeah, it's Reliance, Maruti, Bajaj Finserv. The day is pretty hectic. Well, let me take it across to Vinny, find out what the global commentary has been like, especially after the US economic data points coming in. Vinny?
Good morning, and absolutely we'll be starting with that GDP data that came in the US, and Peter Schiff is talking about that 4.9% growth that the US has seen in the GDP does not only indicate in terms of a stronger than expected economic growth, but there's a highlight that is coming in is that it is higher than reported inflation concern also that comes in over there. Now, GDP growth was mainly driven by higher consumer as well as government spending that he's highlighting, but more than that, the gain of result resulted from the higher prices than the 3.5% allotted by the GDP deflator. So that's one concern that he's highlighting. Other than that, we also have commentary that has actually come in from Janet Yellen, and who's highlighting in terms of the growth that we've seen. Third quarter economic growth was nearly at 5%. She's highlighting it was a good sign that the economy was headed for a soft landing, but could help keep the longer dated bond yields elevated at a higher level as well. That's one thing highlighting. And furthermore, quoting her, she's saying that it is a good, strong number and shows the economy is doing well. But what they are looking out for is the soft landing as well. Now, moving on, we have ECB's Christine Lagarde, who's talking about the growth as well for UK and in the European Central Bank side. They're talking about the economy is likely to remain weak for the rest of the year. They believe the economy should strengthen from the coming years as a real income starts rising further, and inflation is likely to come down further in the near term is what she believes. So let's keep an eye out the commentary coming in from her as well. Lastly, we have commentary that is coming from Kathy Woods, and this is in terms of the government statistics that are highlighting certain things in terms of capturing the weak economy, and many companies are reporting shockingly weak revenues. So that's what she's clearly highlighting, that if one is actually seeing the US employment data still so strong, then what is supporting the government's point of view in terms of that? They believe that now labor hoarding after 2 years that they'd seen of the COVID vaccines, demand side, that is supporting the demand side, but in terms of the supply side, there's a concern in terms of the lower purchasing power that is coming in, especially for food and energy, and the reason that is mainly for the supply side. But what they're further highlighting is that if they are right and the prices are going to unravel, they're going to see an impact coming in on the margins, then companies would actually have to start laying off employees, the excess of labor that they have over the last couple of years, and also maybe harness to something like an AI or an automation to salvage the margins as well. So that is one concern that they are highlighting, that if we see these prices concerns coming in, then that's a concern that one should watch out for.
We'll leave it at that. In fact, let's pick up all those points. We've got Adrian Movad as well joining in on the show right now. Adrian, hi, morning. What's been your reading of the US GDP data? And, that somewhere clearly indicates that rates will continue to remain elevated.
Yeah, I mean, the data remains incredibly robust. I mean, if you think about this in nominal terms, the US economy expanded at more than 7% on an annualized basis. So that's pretty good news for corporate America. So think of nominal GDP as a proxy for all companies' top lines. So we've got a robust economy, we've got an economy that's generating jobs, which means that interest rates are going to remain above 5%. And I think the big mistake that was going on in capital markets was in the bond market. The yield curve inverted in March last year. And there's an incredible arrogance in bond investors. I always think they think that their market is always right and it's going to predict what's going to happen. Now, 18 months ago, we have a yield curve inverting, and the US economy has just printed 7% nominal growth. And that the real problem in markets has been that we've got a secular story. And the secular story is we're going out of the extraordinary period, which was the period post the GFC, post the Euro crisis, when you had ultra low interest rates, you had central banks buying bonds. At one point, we had more than 40% of G10 government bonds with negative yields. We're now going back to the pre-2000 level. And the fair value for 10-year bonds is probably somewhere between 4.5% and 5.25%. So we've had that adjustment. That adjustment has been quite quick more recently. And whenever you get volatility in bond markets of that extent, you will get corrections in risk assets. And I think that is the story of October. It's the equity markets sort of finally thinking, boy, that's a big move in the bond markets. We're a bit nervous. Let's process that. And you get this correction, as you were describing earlier in your discussion, a correction in a bull market, but the correction can be pretty vicious. And that's what we've experienced in the last week. So just to conclude, I think I'm more comfortable about the bond market. I think a level around 5% is reasonably good in terms of fair value. We then need to think about that discount rate and apply it across asset classes. And I still think there is some stress out there. I'm particularly concerned about private equity, private credit, where I think there is a mispricing of assets. And there's still, to some extent, maybe a mispricing of some growth assets in the listed equity market. But I'm feeling much more comfortable now that bond yields are near 5% than I was when the yield curve was very inverted.
The narrative at the beginning of the year was that US economy will hit a mild recession or it could be a case of soft landing. Now we are staring at real growth. So what changes in terms of the key assumptions for investors who are investing into emerging market? Because if US economy is giving you a 5% return via the bond market, and if the economy is growing at 4% plus, I mean, that's a great place to be in rather than hunting for gains outside US.
Yes, but let's be conscious that there are challenges when the US economy is strong for emerging markets. So the first challenge is that discount rates have gone up. So at the short end, I can buy, short duration corporate bonds and get a yield of around 6%. It's not entirely risk-free, but it's pretty low risk. So if that's my starting point to take on extra risks, the return, the equity risk premium that I'm going to demand is just going to be higher than it has been when we're in the ultra low interest rate environment. So I've got a strong US economy leading to higher discount rates. The other thing it does is it gives you a strong dollar, and strong dollars tend to be a bit of a headwind for emerging markets. But I would suggest that really that's been the story of 2022 and most of 2023. And as I look into 2024, I think these significant headwinds are moderating. And I would be looking to put on risk in emerging markets. We've had a massive change in expectation around China, gone from being very optimistic about Chinese economic growth, the pace of economic growth, to extraordinary pessimism now. I think that's an attractive story. It's much easier to beat expectations when you're this pessimistic. And then if we look at the other major emerging market in the region, India, the Indian economy continues to surprise on the upside, remains very resilient structural growth story. So looking at the two big EMs, I'm pretty upbeat. When we think about Korea and Taiwan, again, I think if the cyclical manufacturing story, and remember, manufacturing's been in recession for a relatively protracted period of time. If you look at PMIs, it looks like the manufacturing recession is moderating, and we're beginning to see some PMIs move above 50 for manufacturing, and that's probably good for Korea and Taiwan. So I would be selectively looking to add emerging market risk. having tried to avoid it because of the headwinds I described already in terms of high bond yields and a strong dollar.
Adrian, what to your mind could be the relevance of geopolitical tensions in Middle East? How relevant is that for financial markets? Up until now, markets have ignored that, but can markets afford to ignore that?
Yes, so I think I mean this is a terrible humanitarian crisis, what's going on there, and at the moment the impact on the global economy is very, very minor. We have to though reflect back to the 1970s, and you did have an oil embargo which was related to the Arab-Israeli war, and so if we were to see a broadening of the countries involved in this conflict, then I think that would start to become an issue for the global economy and a more significant issue for capital markets.
Adrian, thank you for taking time out and joining in and giving us an insight as to what your outlook is on the global economy as well as where India and emerging markets stand. Let's move right on and chat technical. CA Rudramurthy now joining in on the show. Rudra, good to have you on board. Let's talk about the meltdown that we witnessed yesterday. All sectors in the red. You had the broader markets as well, which succumbed to selling pressure. And it was 18,850 just about being held on to. What is this indicative of? More of a sell-off today?
See, for me, definitely markets are highly oversold and there is every chance for a short-term bounce to come in market. And if you see charts of Nifty, 18,650 is a very, very strong long-term support. And I doubt this 18,650 crucial level will get broken. And however, on the upside, the earlier support, which was at 19,250, is now acting as resistance. So market has shifted downwards in terms of its range. Now the range, broad range, will be around 18,650 to 19,250. Also, the monthly series which got ended yesterday is also telling me that we are now starting a fresh series and all the positions which were there already has got rolled over and whatever has to get unwinded has already unwinded. I will be very stock specific in this market, definitely not at current levels to short because risk reward is not on your side. If you are a short seller and to sell this market, wait for a bounce, let it go back to those earlier support acting now as resistance of around 19,200, 250 zone, rather at yesterday's level of 18,850, that offered a great risk reward to go long. If you look at Bank Nifty levels, similarly, I see support coming to Bank Nifty at around 41,900. So at current market price, the risk reward definitely does not favor me to short. In fact, it is other way around. I would love for a buy trade, a short-term retracement trade or a pullback trade, which is definitely there in market. I expect more short covering to come and a short kind of a move on the upside to come both on index and market will be very stock specific. So the earlier support which was there on Bank Nifty will now act as resistance and on charts that level comes at around 43,350. So the range has now broadly got shifted into those 41,900 to 43,350 zones on Bank Nifty. And on Nifty, it will be 18,650 to 19,250. And at current level, shorting definitely does not give you a great risk reward. Rather, buy with a stop loss. And if you are a short seller, wait for a bounce to sell and not at current level.
All right, that's views and levels to track on the Nifty Bank as well as the Nifty. Rudra, a quick take on your stock calls?
See, in yesterday's market where you saw mayhem, there were a lot of good stocks which was still holding in yesterday's bad market. So if you can identify them and buy, that will be a great trade to make on the long side. So for me, ICICI Bank even posted its good result because of market sell-off. Even this stock got sold off, but it offers now a great risk reward to buy. On private banks, my top pick will be ICICI Bank. Buy at current market price, keep a tight stop loss of 895, expecting an initial target of 934 and then 950 to come. A great risk reward buy. McDowell also looks very, very strong to me. And yesterday it clearly showed that signs of resilience, and at current market price, for me, it's a great buy. Keep a stop loss tight at 990, looking at initial targets of 1065 and then 1100 to come. And finally, even Escort is very, very strong to me. That's the stock to buy at any price. Look at initial targets of 3220 and 3400 to come on Escort. Keep a tight stop loss of 3070 for the same. And all the three stocks are available in F&O. Take long positions and strictly follow the stop loss and have a great risk reward trade on the long side.
Okay, Rudra, stay with us. Lots more to chat about, but let's discuss some of the other stocks which are going to be in focus here. And Samit is here to flag off exactly that. Samit, first, let's revisit your exclusive news break. Jio Financial promoters buying additional stake.
Well, what we understand from our sources is that over the last 2 days, they have bought around 2 crore shares. And before buying that 2 crore shares, the promoter had an intent to buy around 2.5 crore shares from the open market, of which they have already bought 2 crore. So another buying of around 50 lakh shares can be expected in Jio Financial from the promoter group, that is the Mukesh Ambani family group. Now, on August 29th, we had already broken the story where the promoter had acquired 5 crore shares, and this was confirmed when the Q2 shareholding pattern data had come out, where they had clearly added close to 6 crore shares in the post listing. So since listing, if you see, the promoter group have already increased their holding in Jio Financial by around 0.97%, and post the recent tranche buy, their holding in Jio Financial would increase by another 0.5 odd percent to close to 47.2%. And one more interesting thing that what we have noticed here is that when the last tranche was bought by the promoter, around 5 crore shares on August 29, the share prices of Jio Financial were trading around 206, 207 levels. And in the last couple of days also, we had seen similar kind of share prices for Jio Financial. And that's when again the promoter had come in and bought close to 2 crore shares from open market. So it clearly shows that the promoter is intended or is clear to buy more or to increase their holding in Jio Financial, even going forward if there's a fall in the share prices. Right, Nikunj?
See, Samit, the promoter has a time horizon which is in years and decades in this case. But for an investor who's got a time frame of 1 to 3 years, the question is that, okay, this is a company which is from the house of Reliance, and looking at the track record, of course, they've got all the ingredients in the making. But the market cap of Jio Financials right now as we speak is actually about 1,50,000 crore.
Close to 1,40,000, 1,50,000.
1,50,000 crore. On 1,50,000 crore for a business which has just got about incubated, and the profitability from the core business is only start in FY26. I'm talking about the bumper profitability coming in. There is a long delay. Now markets have given respect to the pedigree, and the market cap is 1,50,000 crore. Now it has to be delivery, tie-ups, RBI approvals. So while it's all exciting to say that this is going to be the next big platform company which has got all the ingredients in terms of technology, connectivity, global tie-ups, that's all great and that will happen. But I think that is WIP, which is work in progress. And for a business which is work in progress for next couple of quarters, it will have to go through its birth problems, it will have to go through its scale up challenges. Then the market cap of 1,50,000 crore I think is a decent market cap. The price to book is also not sub 1. It is more than 1.2, 1.3 times.
3 times actually.
Which makes it very expensive. If I compare that with other NBFCs, what are the valuations of Bajaj Finance?
Bajaj Finance is the expensive one at around 6 times, but then other NBFCs are on the lower side.
Bajaj Finance 1 year forward, I think it's trading much below its COVID price. That's what I think.
It's below COVID, right? But it's still higher than what
exactly.
Bajaj Finance.
So then the choice of other profitable franchises are there. So I think that is a toss-up now. What do you do as an investor? Now the promoter has a 5, 10 year, 15 year vision. So of course you'll get it right on that horizon. But do you have that much horizon? Can you align with the promoter vision and stay to your stock? Then that's a different kind of an investment. So I think now the stock would be a function of approvals, scale up, tie-ups, and RBI mandates.
Okay, fair enough. So I guess it also depends largely on the investor's time frame. But the other stock on the radar is Shriram Finance, talking about its numbers. And I guess, Samit, we can sum it up as a pretty healthy quarter.
Well, it was a beat actually on all fronts, beat NIM, AUM. On all fronts, the company has managed to give a strong set of numbers. But the best or the unexpected beat was on the net interest margin front. It expanded by around 50 basis points on a Q-on-Q basis to around 9.5 odd %. And this is largely on the back of the fact that the AUM growth was much higher than the NII growth. AUM growth was around 20% on a YY basis. Our analysts were expecting this number to be around 18%, but that has also come in ahead of what the street was expecting. On the asset quality front, pretty much stable on across all segments except for the farm equipment segment, but other major segments, the asset quality has been pretty much stable for the company. Now, given the fact that the growth was strong in the first half, management on the call has actually upgraded their guidance. Now, they have upgraded their loan growth guidance to around 18 to 20% from 15% earlier. And on the NIM front, if you see, they have given a higher upper end of the guidance. That is, it was earlier 8.5, but now they have also introduced an upper end of around 9%. So this means that NIMs could sustain even at these levels going forward for Shriram Finance. Now, one concern that was there for Shriram Finance was on the unsecured loan. In fact, it was for the entire banking and the NBFC space as after RBI had highlighted this fact. And for that, management has reiterated that they would keep unsecured personal loan capped at 8%. So no concern on that front, plus good growth, and management has also upgraded guidance. And when it comes to valuations is at a steep discount to its peers. In fact, some of its peers have a lower ROE as per Morgan Stanley, and also valuations are lower the pre-COVID or 5-year averages as per Morgan Stanley.
You've summarized it very neatly. I mean, in terms of why there is a case for Shriram Transport Finance now to outperform. All I would say is that, look, this stock in a sense is also a stock which tends to benefit when interest rates stay stabilized, because the large part of the borrowing for them is actually from the wholesale market. And wholesale market rates, and given that India's bond inclusion will only increase flows into the bond market, I think stocks which are NBFCs which are dependent on large wholesale borrowing, they tend to outperform when interest rates they tend to peak out. So the macro is strong. The business is looking decent, valuations are also supportive. So even though the stock has had a bumper year, it has done rather well this year because the overhang of stake sale and everything is over. It has scope to move closer to 2000 rather than go back to 1500.
Okay, that's the take coming in on Shriram Finance as well as Geo Financial Services. Samit, thanks for flagging off both those names. In fact, we're going to be chatting with the management of Shriram Finance as well later on in the show. For now, we're going to take a very quick break. Come right back. We'll have Sanjeev Bhasin join in and tell us what he's making of this week market and whether there are ideas to buy in this recent correction.
Welcome back. Sanjeev Bhasin also joining in on the show. Good morning, Sanjeev. Thank God it's Friday, I guess, but it's a very busy day despite that. Lots of big earnings that will be coming out. Do you think that Reliance Industries numbers is not really going to be market moving? What's the view?
Yeah, good morning, Avanne. Thank God it's Friday. We've lived the worst 6 days ever in a long time, and there was no stopping, and who thought that Reliance and HDFC will continue to be hitting new lows? So it just tells you that the markets are definitely over optimistic and over pessimism. It comes in within weeks. I think we are so heavily oversold that you can have any trigger now to trigger an upside. Simply put, I'll just give you a brief. Crude hit $97 on 28 September, much before this Gaza crisis. And after that, it has not even retraced 0.32%. So I think crude is weak. Bond yields are pricing in on the first. The Fed is on hold. You cannot have growth and jobless numbers both rise in sync. 3, I think that the dollar is definitely on a weaker wicket as we go with crypto hitting 35,000. So I am of the view that all this over pessimism was done up because of this expiry. A lot of froth in the mid cap, but all that is past. Look at the results. Look at the results yesterday from PNB and CanBank. You could see a whole host of other results, including the likes of Dixon Tech. I think numbers are very, very flattering, and they should actually be, upgrades now, given the valuation comfort. So gung-ho on the index on large caps, and I think that the next 10 days should be very, very sweet once we are through with a couple of events like the Fed and so on. Markets globally are oversold. I think anything Reliance could be a trendsetter today on the back of results. Pessimism is at its highest, and this is where Reliance will generally start to move, and the index.
Okay, so Sanjeev, we were also discussing the outlook when it comes to large cap banks, given that they're in a sweet spot right now, be it on the valuation metric, the growth, visibility, a lot of NPA concerns behind it. Is this fall a good time to buy into some of these large cap banks?
Yes, Avan, definitely. Bank Nifty's hit 6-month lows and was at almost 46,500 in the second week of September. So I think Axis numbers were leading from the front. ICICI, I think the stock has fallen more in market sentiment. The numbers were fairly ahead of street. Kotak numbers were good, and I think HDFC now at this level is a must buy. So if anything, I would bet on the Bank Nifty, and you have Can Bank and PNB to add at it. This 42,300 can easily give you a 10% upside on the Bank Nifty. Mark my words, by the end of this year.
The confidence when it comes to the large cap banks. But what about the likes of a Maruti, given that they will be coming out with their quarterly print? What do you think the street is bracing itself for?
Well, numbers will be the highest ever and the best ever in the history of the company. And like I told you, since I've been proxy to having my office right next to their warehousing side, I know for a surety that the type of trucks I've seen in the last 6 months come in and come out have never been there in the last many years. And it's telling you that they are now roaring their way. They sold 1 lakh cars just in the Navratras. So agreed that the valuation is not cheap, but with market sentiment, 12,000 by the end of the year is very much on the card. This will be one of the legs on the upside when we start to retrace this Nifty fall.
Specific, wanted to understand, morning firstly, what's leading to this collapse in the mid and small caps? Were they getting overheated as a pocket, falling under their own weight, or do you think this is sheer capital protection which is currently at play because they are the ones which have seen better returns as opposed to large caps?
Yeah, morning, Ayesha. It always happens when there is good money made on the trading side. It flows into mid caps. PSU mid caps were underexposed from the mutual fund views, hence they got a lot of flows there. But remember, mid caps have a higher impact cost. The entry means you will have to enter with a gap with 5, 7, 10% just in entering. And when you exit or when profit booking comes in sync with the market correction, they fall more than that. And that is what was happening. Actually, there was a lot of froth in some of the PSU, whether it was defense, whether it was rail, whether it was, the power lenders, all that was building up. But I think a lot of that cleansing has taken place. And I again reiterate, I think Reliance HDFC point are giving you a very good entry point. I was making note of what Nikunj said, that the promoters of Jio have a long-term view. But then long-term wealth is always made at the heights of pessimism. And I think that you have some now pivotal stocks, particularly Reliance, HDFC, Lever, and Ultratech, which are giving you very good entry points. So I am very optimistic on both the indices, the Nifty and the Bank Nifty. I think they have been overdone in this sell-off or profit booking in the mid caps. And mid caps, I think, will again retrace themselves after a little bit of consolidation.
Talking about mid-caps, ET now has been learning that market regulator SEBI has proposed a new high-risk category for mutual funds and has also reached out to AMFI for its feedback on the same. SEBI has sought feedback on the structure of the proposed asset allocation. In fact, sources now tell us that the proposal is very much in the consultation stage so far and no formal process has been adopted. But let me quickly take it across to Ankur Mishra and get in more details. Ankur, why is SEBI keen on this new category? And what will be the implications of this move?
Yes, sources say that high-risk mutual funds are under consideration by the market regulator, as we understand that a letter has been written to industry body AMFI, and in that the proposed structure has been asked to the industry how it should be, what should be inclusions and exclusions, should there be any limit or not. All these questions have been posed to the industry. Now it is up to industry to reply to the market regulator. We understand that these discussions has happened in the past also, but it is like a first step which is taken by the regulator to test the waters, to understand that how high risk mutual funds may work, because we understand that regulator wants to give option to investors who can afford to take high risk, so that option should be there with the investors, because many times we have seen that these kind of investors go for unregistered fund influencers, mutual funds. So market regulator wants all these investors also to come under ambit of SEBI, regulated by SEBI, and hence an option like this is under consideration, in which there can be investment in high risk derivatives, in micro caps, in small caps, but only for those investors who understands it.
All right, thanks very much for giving us that roundup. Let's move right on then. And Sanjeev wanted to get in a view on some of the other stocks that will be in the spotlight today. Some brokerage notes coming out on Asian Paints post the results, saying it was a miss due to the delayed festive season, erratic monsoon. What's your outlook on where gross margins could be headed, or the kind of management commentary that they gave for Q3?
Yeah, so Avanne, I was not privy to the management conference, but I know that there has been a slight delay in the schedule of holidays and the festive season, and it's a seasonality factor. We know that now next week onwards, a lot of the festivities start, and I think Asian Paints, given its 53% market share in decorative segment, given that crude has not actually flared up, and if crude prices start to correct from here, that will be an added advantage for it. But they are coming from a very high base. Now to maintain that base and grow at 18% is not all that easy. So I think a high single digit or maybe high middle double digit growth will be on the cards. But like I said, this has been a pedigree stock all throughout, and you can't have doubted the numbers. 1 quarter or so of a little bit near-term miss, and that also miss of few crores on the numbers is not very much. I would again add that to be a proxy play because of the coming festive season, the festive demand for housing. You yourself know in Bombay, the type of sales which have taken place in the last quarter or the last month have been the highest ever in the history. And I think that, the wealth effect is tremendous. So that will drive home building, commercial building. And as a proxy play, cement and paints remain a very good conduit for that.
Right, okay. That's the take coming in on how to benefit most from this realty demand boom that is currently taking place, or has been for a while actually. But Sanjeev, anything between mid and small caps that you're liking right now, which you think is attractive?
So the power lenders, I think on corrections, REC, PFC must be accumulated. Today we are going with PNB and Can Bank. As a disclosure, PNB, Can Bank, BHEL should be the ones which are to be bought today. If you are a momentum trader, today there will be momentum and it will last. I can again assure you that pessimism comes at the darkest hour, where you always will be at your nerves, but that is where the market generally make a turn. I think numbers were much ahead of street. Can Bank has been a very big outperformer, and I see no let up till 400 rupees at least in this series itself. PNB can easily retrace 80. PFC, REC again look very set for a 10% upside, and BHEL again a very, very under-owned and very hated stock, but numbers and the advent of power distribution and power stabilizers, all that is adding up to that. You know that the EV venture is very strong. BHEL is a conduit for setting that up. I think BHEL can retrace itself for a 15% upside in the coming 2 weeks.
Have some of the railway and defense stocks run their course, or would it be a prudent time to even dip in here?
Yeah, so Avanne, yesterday I was hearing one company in the US, RDX, or I'm forgetting the name, but their management said we've had the best time in our lives. First it was Ukraine, now Israel is asking us for more and more arms supplies. So I think the US, contrary to what it is, it actually is a capitalist. Anywhere there is a war, arms dealers do well. And in the Indian context, we know that defense has been the mainstay of Made in India. Now, I'm not making the case to buy these stocks immediately, but you have to own them in your portfolio. And if you are waiting for a correction, then Hindustan Aeronautics and BEL would be very, very prudent buys. It's not that anything on the war side, but it's always that defense and defense building is now become a very big industry in India. And like I said, execution may take some time, but order flows are strong. So I would go with the BEL and HL to be added on decline, or do a SIP, because these are must-haves in your portfolio, and that time give you good stocks at good prices.
Okay, BEL, HAL, PNB, CanBank, PFC, REC, a whole host of ideas coming in from Sanjeev Bhasin. Sanjeev, good to have you on the show. Thanks as always for joining in. Let's welcome on board Sandeep Sabharwal as well and find out what he's making of the market texture right now. Sandeep, hi, morning. Have we fallen enough to see a recovery and a meaningful one at that? At least global markets have rebounded.
Ayesha, so I think like we were discussing yesterday, in my view, a big part of the correction is over. It's possible that Nifty could give up 300-400 points more from these levels if there is some sudden global shock or as in a continuation of the sell-off. But that is fine. So I think we cannot always try and pick out the bottoms in the markets. So we have to pick out the right kind of stocks at this point of time. So initially, I would think that large cap banks, stocks like L&T, some auto stocks, I think these on the large cap universe should be preferred. And as results come out, we will see if there are some other opportunities coming on mid caps.
Your radar, which you would buy on a bad day, and what was on your radar, which you already bought?
So we have bought more of ICICI Bank, Axis Bank. We are continuously accumulating Voltas and Aditya Birla Retail because I think those are two stocks in value zone. Near term, people are concerned on their performance outlook, but I believe that they have corrected enough for generating reasonable returns over the next 1 or 2 years.
I want to go back to that FI net short number, and it is at 89% now. FI cash sell number yesterday, one of the highest I've seen, and there were no large block deals, there was no large P exit or something like that. So the positioning of the market, even though we may say, okay, most of the brokerages are bullish on India, most of the money allocators, they want to invest in India, valuations are not at a bubble level, but our fair weather friends, where are you guys? The FI in the FNO market, we look at the net long short, I think is at a record high. FI selling not at a record high, but these are fat numbers which are coming on a daily basis. And Sandeep, while we may look at the number and say, okay, why FIs are selling, both of us have a slightly contra view when we look at this data, which is that just tells you there is no euphoria and excitement.
But there is no euphoria and excitement, and all of us need to understand that a lot of the foreign outflows are not necessarily related to what is happening in India, but what's happening in the emerging market basket. Because many of these funds are ETFs which invest into emerging markets, and it's possible that some of the sovereign funds might be reducing exposure into emerging markets because they tend to follow returns. So when returns decline, they want to protect their returns and as such end up selling. But that's fine. We shouldn't pay too much attention to this kind of funds flow because ultimately this kind of selling only creates value.
Look at some stocks which recovered very smartly yesterday, intraday, and Rudramurthy, they're coming your way. Defense stocks made a comeback. Names like Zomato, they made a comeback. MCX, BSE, they made a comeback. Anything which is catching your attention purely based on yesterday afternoon's or yesterday's price action?
See, for sure, BSE charts look very, very strong to me, and it's a buy at any price kind of a chart. I know, yes, it has definitely moved up, and it has, in fact, from levels of around 880, where it saw the first breakout, from there it is now closer to 1800. I know the stock has doubled from there, but still for me, it's a buy. And any dip like what you got yesterday, an opportunity to enter closer to 1600 was a great buying opportunity. 20-day moving average comes closer to around 1470, and that's a dream price to get. But however, yesterday kind of a dip or any reason because of overall market mayhem, you get it at lower price, yes, I will have BSE in my portfolio, and it's a good stock even for momentum kind of a traders who want to be into good company. And even for me, MCX also offered a great opportunity, and even at current price, I will be a buyer in MCX. And if you can just get it closer to levels of around 2150, it's a great price, but I will be a buyer at current market price and on any dips to levels closer to 2150. And for me, the chart patterns of both BSE and MCX are on a clear buy side. If I have to pick up some more stocks, I do definitely agree with Sanjeev Basin. Yesterday results of CanBank was very good, and it offered a great risk reward trade for someone to get into good stock available in F&O. For me, CanBank is a really good stock, and I can name some more if you want. Manappuram, another stock which looks very strong to me, and yesterday it was available to you at those levels of 126, 127,
Right.
where I know people were buying this stock at higher level.
Right.
So these are few good stocks to buy.
Okay. So now what we are doing today is that we are asking every expert how do you approach mid and small cap stocks, and that's the special which we are going to be taking forward. So Sandeep, we've got your thoughts on where the correction is moving, but let's say if I have to ask you again, and that's a special, we've got Sandeep, we've got Pankaj, you've got Devina, and we've got Pankaj Tibrewal. So Sandeep, if I have to put this point across on digital and perhaps carry on later shows, my simple question to you is, it may be repetitive, how should one approach mid and small cap stocks now after a sizable correction? 5% on the index, 10% perhaps in some of the ranked names.
Yes, so I think people are concerned about small and mid caps, but big value in India will be created in small and mid caps only. So people shouldn't be scared of investing in them. They need to be ready for the volatility which will come. Some stocks will correct 15-20% from the top also. And there are times when these stocks fall so much, you think that I should have sold before the fall. But after a few months, you realize that, and then the feeling is it's good I didn't sell because these stocks the companies are doing so well and the stocks have moved up. Unless you are in speculative stocks where you don't know why you have bought them, I think small and mid caps in India will do very well next few years.
Murarka, good morning. Same question to you as well.
Hi, good morning. I think obviously all of us know that the small mid-cap companies, because the smaller size, tend to deliver much higher growth. I've always said this, India is a paradise for growth investors. So I think investors should do what they've always been doing, which is focus on investing into high quality growth companies. And while we're in the midst of this correction, we've seen a meaningful correction in a lot of good quality growth companies' prices. So you use this as an opportunity, have a slightly more longer term horizon. When you invest in mid caps, I would say that one should have a time horizon of at least 3 years when you invest into mid cap companies and invest into high quality growth companies.
This is theory. पंकज मुरारका, ये तो थ्योरी है भैया. अब थोड़ा प्रैक्टिकल बताओ. 2 दिन से मिड कैप गिरा है, 15-20% लॉस हुआ है. Let's have a practical approach. Okay, buy good quality companies for 3 years at reasonable valuations. This is theory, my friend. People right now want to know whether they should cash out of small and mid cap stocks or use the remaining cash what they have to buy into this decline. Let's have a very basic approach here.
I think there are pockets of markets where you can find good companies at reasonable price. So you have to be selective in stock picking. It's difficult. I'm not an expert. I don't know where the markets will be in the next week or 10 days. But I think there are good companies out there, and meaning investors should use this opportunity. So it's more about stock selection than the broader market, because it's difficult to predict markets in the next week or 10 days. But if you have a 2-3 year time horizon, given the inherent growth of India, there are enough number of companies which are growing at 20-25%. So if you can buy some of those companies and just sit tight and on them over a period of 2-3 years, you'll make good money. So while there's meaning, as the saying goes, whenever there's panic on the street or there's capitulation, we have seen some early signs of capitulation in the last few days now after this strong run in mid cap, small caps. Having said that, obviously there are pockets of mid cap, small caps where there is a lot of froth also. So investors should avoid those speculative segments of the markets, is what I would say.
Sandeep, where do you find speculation in the market? Because, truth be told, there was a lot of froth which had built into the mid and the small caps. What would you say? Be wary, don't touch these spaces within mid and small caps.
So I would think that there are very highly leveraged companies with very high debt levels where people are playing for a turnaround. And since they are so heavily leveraged and the interest rate cycle is also going up, the probability that turnaround will play out in many of these companies is low, the possibility. So I think those are the spaces, and many of those stocks have moved up very sharply. So people need to be careful about those stocks, I would say, in the small and mid cap universe. X of that, I think longer term growth trends of many companies will never be 30-40%. It will be much lower than that. So wherever valuations have gone up to 60, 70, 80 times price earning ratio, those are never sustainable. So ultimately there is aversion to mean. So if you are in those spaces, I think that's another segment where people should be careful about.
We've been waiting to hear Sanjeev Prasad's view on mid and small cap stocks, and look what he has to say. Valuations remain expensive for the broader market. Mid and small cap stocks have not reached what could be called as fair value. Now, Kotak was one amongst the first brokerage house, slightly ahead of the time. They came out and said that, look, we are of the view that one should not invest in small and mid cap stocks. That famous report from Sanjeev Prasad with Seta mailbox. Now he's come back with another report. Large cap stocks offer better risk reward valuations, balance sheet more reasonable, and mid and small cap stocks do not offer that kind of a comfort level. He's talking about the category in general. Pankaj Murarka, what are you buying where you think that in next 3 to 5 years, you and your clients would be rewarded for the conviction?
So, Nikunj, given the growth investors we continue to buy into. We'll use this correction to buy into more of internet companies which we like, because we still think that these companies will deliver very strong growth over the next 3 years, 5 years, and probably over 10 years. Probably my view, as we've said earlier, we've discussed earlier. Just reiterate. I think that will be the fastest growing sector or segment of the Indian economy over the next 10 years. Apart from that, we like pharma as a sector because we think there's earning resilience in the sector. And more importantly, the sector is coming out of 2 years or 3 years of underperformance and business challenges. And now a lot of those headwinds which the sector faced has turned into tailwinds. So we see good opportunities in pharma across both large caps as well as mid caps, and valuations there are far more reasonable. And apart from that, we like some of the mid-cap banks as well, financials as well, because we think asset quality in the sector as a whole is extremely strong or resilient. We're going through a cycle where, given the strong and very vicious NPA cycle that India had pre-COVID, banks are now going through a cycle where asset quality is extremely resilient or extremely strong, and valuation still remains very compelling. So these are probably the 3 sectors that we are incrementally dipping into.
Shivangi, I'm just coming right to you. And you know, Sandeep Sawaral has texted me already that 9 baje usko jana hai. Isn't it too late to go for Scotch, Sandeep? 9 o'clock? Where do you have to go? Stay back. Okay, but since he has to go at 9 o'clock, I'm going to ask him one last question. Sandeep, which are 3 stocks where you would say that I don't care about what is happening on the geopolitical front, I'm not worried about Fed, election cycle do not matter to me. But these are 2-3 stocks which are my high conviction ideas, and I'm happy to allocate within these 3 stocks or 4 stocks 20 to 30% of my portfolio, irrespective of what is happening in the world. These are, like they say, fill it, shut it, forget it. Old hero on diet, old hero on diet.
So I think it's tough to define that way, but I'll say that on the large cap side, ICICI Bank and L&T would be 2 stocks where I think I would be happy to allocate, and where I believe that next 2-3 years will be good. On the mid cap side, for the longer term, we have holdings in a stock called Wonderla Holidays. I think that's on a very good growth path and that's the only credible player in amusement parks and setting up new parks. It's gone up substantially, but I think it will go up much higher over the next 3-4 years. So that could be one stock. And I would think that Interglobe Aviation is a good stock for investors to hold long term, because the dynamics of the Indian aviation industry are such that Interglobe will continue to do very well, and the way the travel patterns are of Indians, the way the GDP is growing, I think they'll do very well long term. So offhand, I think these come to my mind.
All right, Sandeep, really appreciate your time. Thank you for joining us. Shivangi, apologies, just been focusing on the mid and the small cap stocks in terms of what the basic approach should be. But I'll start with the very basic question. If one looks at the month of November, the data point will just come up in terms of seasonality. November has not been an easy month to call. It's been a mixed month. How do you see how do you think November of 2023 will move for us?
Good morning, Nikunj. Thank you for having me. So we've seen that, seasonality-wise, October was a month where we've performed 9 out of 10 times. But of course, we were highly concerned and influenced by the global, be it the bond market, be it the war crisis. So we haven't seen, some sort of any sort of buying actually. We've seen continuous selling in the entire October month. So November should pan out on a little negative to range bound manner, but of course, with the festivity kicking in, we will see some sort of stability in this entire series. So going forward, I would see that there might be some short covering move in the November series. We've seen rollover of Nifty is fairly good enough. It is near 83% and higher than its quarterly average as well. So overall, we're seeing that it might start on a negative to range bound manner, but then stability should be there and it should turn around from these levels.
Now, for Shivangi, let's also get in a sense as to what you're looking at within the broader universe, given that we have seen that pretty exaggerated fall over the past many days within the mid and the small caps. What's looking good as a top bet?
So on my radar is BSOF. This stock is looking quite positive. In fact, from the entire entire space, we've seen that this stock has remained resilient despite the volatility and global market weakness. The stock is holding on to its 50 daily exponential moving average. Even rollovers are quite positive here, and week on week basis, we've seen that any small declines are being utilized for buying. So this is one stock which is looking quite positive and recommending here for a target near 550 levels and a stop near 515 zones. Now, the second pick on my radar would be Tata Chemical, but this is a sell call. We've seen that there has been a lot of weakness over here and a lot of shorts being carried over. Weakness should continue over here, and we are expecting a little more downside over here. We've seen that there is a weekly breakdown, so this should take the stock now to 900 odd levels, 960 being the stop loss here.
Okay, those are some stock strategies as well. Meantime, Shivangi, just wanted to get in your take then on something like a Delta Corp. It did see some sort of a spike up and a reversal on the back of fundamental news, but yesterday as well succumbed to selling pressure. What's the view at 127?
So see, Delta Corp has lost its momentum from the last 4 months. In fact, there has been selling pressure at any small bounces. So and honestly, this stock is breaking its previous support zones as well. So stock is not looking for a reversal anytime soon. May see a little more weakness. So I think we should wait here. The next levels which are coming out are around 122, which was a recent low as well on the monthly basis. But then again, stock is in weakness. We should kind of avoid this stock.
Let's move right on then and keep you abreast with some of the other top headlines. And at least 27 people were killed and several went missing after Hurricane Otis hit the Mexican coast, turning a popular tourist destination into a scene of mass destruction. The most powerful Category 5 hurricane flooded the streets, destroyed buildings, and disrupted communication, even as the rescue and search operations continue. And back home, starting today, over 2,500 local train services in Mumbai will be cancelled for the next 9 days. This is due to the ongoing construction of the 6th Line project, which aims to enhance the carrying capacity of the suburban train network. The cancellations will affect train services between Virar and Churchgate. Meantime, the Indian para-athletes achieved a historic milestone, securing the highest number of medals in the Asian Para Games and they raised the country's tally to a whopping 82, including an impressive 18 gold medals. And staying with sport, in the ongoing ICC Men's World Cup, England hopes suffered a major blow after Sri Lanka clobbered the defending champions by 8 wickets. England are now pushed to the brink of exit after slipping to the second last position on the points table.
All right, kya khabar hai? Vinny's got all the khabar on D Street this Friday morning.
Absolutely. So today the cover that we have on the street is coming in from Hero Moto, and mainly obviously end of the month we'll be seeing auto sales numbers coming in, and what sources are saying that we're expecting good auto sales numbers for the month of October coming in from Hero Motor Corp. So October sales numbers are expected to be good. Also, let's not forget the company will be reporting its numbers on 1st of November as well, the Q2 numbers. We've also seen a lot of fund buying coming in. Domestic funds are buying into Hero Motor Corp in the recent times as well. The share, let's not forget, is currently trading above the 200 daily moving average levels as well. And even the rollover data, when you look at it in terms of Hero Motor Corp, that's showing a positive indication as well. So yes, good auto sales numbers is what we're expecting from Hero Motor Corp in October. Keeping an eye out on that.
Hero Motor Corp, and it's going to be an important next couple of days, because you will get a raft of information on which way the festival demand would move, whether it is two-wheelers or whether it is four-wheelers. Remember, this time the Diwali effect is actually going to be spilling over in the month of November. So for advertising companies, for hotel companies, for hospitality companies, a lot of pent-up demand which would be there in October now moves to November. And because of that, you actually would see that the November numbers, as we talk about this particular quarter, October, November, December, the last quarter, the numbers actually would be different. So a lot of Q2 would actually move to Q3. And I think that really could be the differentiating factor, because if Diwali, Dussehra, say last year, were beginning of October and end of October, then it is end of October and it is mid of November. So that entire 1 month extension of festival season in India will actually have a big impact in the way how companies would be declaring, indicating and sharing some of the forecasts. Now I want to stay with this graphic. Why? Shivangi, I'm coming right back to you to understand the importance of this, but the relevance of this, Shivangi, is that right now the FI short position in the F&O market is 89% and long position is just 11. Now this is some kind of an historical low in terms of where the FI positioning in the F&O market is. If FI positioning in the F&O market is extremely short, what does that mean for the market sentiment?
FI's long short ratio has come, down to 11%, which it had witnessed around, March this year itself. And from those levels, we've seen, the index moving around, 3,400 points. So we've seen that, whenever this long short ratio reaches its, lower zones, there is quite a lot of, turnaround over here from these levels. From near about 16,800, we've seen that index touch to 20,200 levels after it hit 8%, the FI's long short ratio. So now this, along with a lot of shorts which were added along with the longs liquidated. So this, total situation actually turns out that, there might be some short covering move, but of course, once the, global markets stabilize, and also there has been continuous selling from the FIIs, and they have continued selling from the last few months. DIIs had an offsetting position, so that has been keeping the market afloat. But then again, overall, once the CBOE VIX also stabilizes, we might see some sort of, good movement over here. Now, India VIX for us, it's, not really performing well, because it's not having the relevance, because we've seen that, every day there is an expiry and the volatility is getting absorbed. So we need to look at CBOE VIX to understand the global market sentiments right now.
Let's also take you through what the index calls are. Here is what our chartists are advising you do as a position on the Nifty as well as the Nifty Bank, and it's critical given that we did see a breakdown on the frontline indices and across the board. Buy, Rudra believes that this is a good opportunity, though it's a no trade option from Santosh. And when it comes to the Nifty Bank Index, which remember too succumbed to a fall, Rudra believes that it's a good time to buy the index at the current levels. No trade is Santosh's advice. All right, and as we wait for the markets to open just about 5 to 6 minutes from now, let's revisit a special interaction that we had with Sameer Arora and Dinshaw Irani as the market veterans spoke about some of their top ideas. Listen in.
We are saying that equity markets in the long run do well, but how to do better than that equity market is by you being ready to change if needed or to add if needed, but there is no need when the market is liquid, when the market is visible, that I must today take a 20-year bet. I will take a 3-year bet, and if it is continue to do well, I may add or I may walk away. But since a large number of companies do well in the medium term, but the same companies don't do well again and again, that's why if you see in the long term, private sector banks, really only 2 banks have created wealth. HDFC Bank, Kotak Bank.
वो भी underperform कर रहे हैं.
अब वो आजकल, but also over time. But if you had started in 98 or 97, there were at least 5 other banks, Times Bank and पता नहीं कौन, GTB, Global Trust Bank and Centurion Bank, Bank of Punjab, वो तो चलो फिर, Bank of Punjab, all of them went to zero. But on that day, you can't say I'm buying long term this, you're buying it in multiples of 1 to 3.
You don't see something like this anywhere in the market. If you have to treasure hunt, shake some trees. Can you find this kind of a theme which could be a powerful theme in next 5-10 years?
No, it could be, but I'm saying you don't know which of those fellows will be the winner.
Of course.
So
let's
therefore the
talk
point,
a theme. See, financials cannot be that theme. It's a discovered theme, right? Consumption, that's the India romance.
ऐसे नहीं होता. If you see, if I broadly define consumption, everything will be consumption. You might say now it's shoes, not running shoes. Now it is food delivery. Ultimately, it's all.
Viewers के लिए. What is that mega trend according to you?
I will tell you very simply. In 1 month, our full disclosure of 100% of the portfolio will be there.
Of course.
तो पहले आप फंड में डालेंगे, then only.
और वो 90 days में इन्वेस्ट करोगे ना, 1 महीने में नहीं होगा.
हम तो 1-2 महीने में ट्राई करेंगे करने की. So we won't wait 90 days.
Sameer Arora at his best. His fund is coming. Helios is, up until now they were managing offshore money and then PMS, and now they are managing money. And I think the issue is still on. I think the NFO is still on rather. So please have a look. 71 points for Nifty spot, 400 points for the Sensex. Are we in for a bout of short covering? Shivangi, on a scale of 1 to 10, we start a new series. What are the chances that we could be in for a bout of short covering?
So we mentioned that the November series is looking quite positive as the festivity kicks in. But then again, we cannot rule out the kind of dominance that the bears have had from the last 3-4 sessions, in fact, in the entire week in the last series. So, of course, we are looking at, a slightly positive start, and 888 would be an important level to watch out for. If it holds above these, then the next hurdle that we are looking at is 19250 levels. So this is one, such levels which is forming out for the Nifty index. Now, talking about Bank Nifty, we've seen that after an entire month of being underperformers, it's now showing some sort of, reversal over here as well. But then again, we cannot be too optimistic. We need to look at the other factors as well, because they both the private and the PSU space haven't performed entirely. So we are looking at support zones over here, which would be around 42,200 levels, and the upside 43,500 would be a crucial level to watch out.
Friday morning, are we in for a bounce? Market technical conditions are looking slightly oversold, so are we in for a technical bounce? It's a lot of green on the screen. Mid cap, small cap, and the market breadth. So from where we were same time yesterday versus where we are, there is a big change both in terms of the market mood and also in terms of basic approach. I always say that don't go short on India, and isn't that getting more and more validated? Okay, now what do we have? We've got PNB which is up. We've got Reliance Power which is up. We've got Zomato which is at 108. We've got Bank of Maharashtra. So the tiny tunes in the market, the real chotu, mid and small cap stocks, they are the ones which are bouncing back the fastest. Now let's look at some value stocks in terms of where the transaction I think seems to be high. So transaction is high in HDFC Bank, it's high in Axis Bank, it is high in Reliance and Dixon. Then in terms of absolute percentage gains, I'm just reading the screen here guys, just bear with me. Simple reading of the screen. Well, very strong market breadth, that's what I can say, because rather than getting into individual names here, all I can say the market breadth I think is explosive today, and there seems to be sea change in where we were yesterday versus now. But the stock which I want to revisit is actually Bombay Stock Exchange. because of the sheer outperformance and because of yesterday's recovery, where is BSE? I think it will be up. It's not coming up on my screen, but I can guess it. There you go, 3.5% higher for BSE. It has pretty much knocked off whatever it has lost in that 2 day of correction.
Okay, lots of other earnings, and Dixon Technologies, the earnings are clearly above estimates. The mobile segment has seen a revenue jump up of 77%, 2.5% higher for Dixon as we speak right now. Vodafone Idea, of course, the net loss has widened quite a fair bit, but their margins also have risen actually 100 basis points. So about 0.5% uptick is what you're seeing on the stock, and the 4G subscriber base has seen an uptick of 1.5%. Of course, you know, starkly lower than what its peers, Jio, or for that matter, Bharti report. But then again, it has an improvement of sorts. Shriram Finance numbers have been very strong. It's a beat all across. We were flagging this off in the morning as well for you. Shriram Finance will just come up for you on your screens. A 6.25% gap up on that stock. We'll be chatting with the management as well shortly on the show. There's also RailTel. The revenues are higher by 40%. The EBITDA jump up of 15%. That stock as well has made a move of about 2% right now. Home First Finance came out with its numbers, an AUM uptick of 33%. Aavas Financiers, NIMs remain above that 8% mark, and the ROAs are at a 3.25%. Aavas Financiers also holding up about 1% as we speak right now. Karnataka Bank has raised about 800 crore rupees via preferential allotments, so look out for that stock as well. And I just want to see what Sun Pharma is up to, because remember, Taro has reported a strong second quarter. The numbers came just a short while back. The operating income has come in at $4.7 million versus a loss of 6.8. Not quite rubbing off really on Sun Pharma, but it's in the green nonetheless. Now to the beleaguered ones from yesterday. Let's see what they're doing. The likes of Bajaj Finance, Asian Paints, M&M, they were the heavily beaten down names from yesterday. They're all holding up and seeing a mild bit of recovery take place. But is the recovery looking sustainable, considering where, yes, we've climbed up back above that 18,900 mark and a meaningful comeback for the broader markets as well?